History has repeatedly demonstrated that if it sounds too good to be true, you should dig in deeper. The stock market isn't one of those places where you move fast and break things. The market, well, it's resilient. It'll break you first. Welcome to MGA Investing. My name is D. This video is the final video, part 4 of a 4-part Palantir comprehensive stock analysis using the dumb method to help keep you from becoming someone else's bag holder. The first video in this series covered the D in the dumb method, which detailed why investing in companies with a durable competitive advantage is important for the long-term success of your stock portfolio and to determine if Palantir had a durable competitive advantage. The second video detailed the U, which represents understanding how the company makes money and the significance of its importance for the investor. The third video in this series addressed the first M in the dumb method, sometimes referred to as M1, which demonstrated how to measure management effectiveness and why it's important. You can find all 3 videos in the links below in the description. This fourth and final video of this 4-part comprehensive Palantir stock analysis will discuss the margin of safety. As a short recap, the dumb method is an easy to replicate and reliable method for analyzing an investment without the need for sophisticated math, insane spreadsheet skills, or stock analyzing software. My assertion is, if you can read, you can analyze. If you've watched any of my stock analysis, you know by now that I'm a stickler on having a process. I believe it's essential to long-term success in the stock market. Again, if you can't describe what you do as a process, you don't know what you're doing. It adds needed structure and consistency to the decision-making process and neutralizes emotions and biases from the buying and selling decision that often cloud good judgment. The second M in the dumb method, is also known as M2, is focused on margin of safety. This is about identifying an optimum stock price that makes sense for you to buy the stock. Again, I'll say this over and over again. No one has a crystal ball, but we can look at the company and determine if it's worth the current selling price and answer the question, is it currently undervalued or overvalued? There's a variety of methods and spreadsheets that you can use to try and place a valuation on a company. Dividend discount, discounted cash flow, or each offers some level of value, but none are perfect. Although financial statements and other numbers are important, we have to realize that these companies are run by fallible humans capable of a variety of errors and of making good and bad personal and business decisions that can impact the numbers in a way that no one could have possibly predicted. Not to mention the impact of climate or world affairs. But at the end of the day, we try to take the best available information and make the best possible decision. I always say you can place some of the best investors in a room together with calculators and computers, and each will come up with a different valuation of what they think a particular company is worth on a per share basis based on what factor in their formula they give more weight to. Palantir is another one of these companies that doesn't require any sophisticated math or fancy spreadsheets to figure out if it's undervalued or overvalued. If we can determine if the company has some degree of a durable competitive advantage, and if we can easily understand their revenue model, and we can see that the company is moving towards profitability, and we feel good about management, we know we're headed in the right decision direction. Let's just take a look at the 2-year chart. We can look back around October 2020 or November 2020, just after Palantir went public and when Cathie Wood purchased over 1 million shares for the ARK Next Generation Internet ETF, and at the time, that purchase represented 0.50% of the fund's assets, which was the second lowest holding in the ARK Next Generation Internet ETF during that time. Fast forward to January 2022, and Cathie's ARK investment owned over 24 million shares of Palantir, which makes up just over 2.5% of the ARK Innovation ETF holdings. Then there is over 2.9 million shares of it in the ARK Generation Internet ETF, representing just over 1.5% of that fund. Then about 477,000 shares of Palantir in the ARK Space and Innovation ETF, just so nearly 1.75% of the fund's holdings there. And then this past Monday, February 1st, ARK Investment cut loose 250,000 shares of Palantir, about 150,000 from the ARK Innovation ETF, which represented just about 0.61% of that fund's holdings, and 103,000 shares from the ARK Next Generation Internet ETF, representing nearly 3.5% of those holdings. Just pennies in an ocean of Palantir shares that ARK Investment owns. We'll have to keep our eye out on this to see if it's a trend that develops, or maybe Cathie was just doing some calculated rebalancing to purchase something else with a shorter and higher return potential that had enough upside to cover some of the loss and some. Only time will tell. Despite Cathie's recent sell-off, she had up to that point seriously doubled down on her conviction, either because she really believes the Palantir story she's been selling or because she needs you to believe it. Just think, back in November 2020, Palantir was selling for around $9 per share and had a market cap of $44 billion that shrunk back to just under $38 billion in 2021, and it's currently sitting at a market cap of $25 billion today. It's now been 2 years since Palantir's IPO. They've signed numerous new government and corporate contracts since. They've ended 2020 with a full year revenue of $1.1 billion and may have closed out 2021 at $1.5 billion or better. So nearly 2 years after the IPO, and without putting pen to paper, anything below $15 a share could be seen as a bargain right now. $13 is better. This doesn't mean I don't have some serious concerns, which I discussed in part 3 of this Palantir comprehensive stock analysis. If you haven't watched the previous 3 videos in this series, I'd encourage you to go back and view those so you know what I'm referencing. Other concerns are its high dilution on 1.9 billion shares. It has increased its number of shares outstanding by a whopping 108% since its IPO. Not great for the shareholders, but great for Alexander Karp and friends with their heavily weighted share-based compensation plans that leave the co-founders at the top no matter what happens. I cover this extensively in part 2 of this 4-part Palantir comprehensive stock analysis if you want to go back to that video and check it out. The link will be below in the description. I'm not so sure how safe the investor is at this point, and I really don't have the patience to really carry the Palantir bag for several years. Compare Palantir's outstanding shares to that of Teladoc that has 160 million shares outstanding and a market cap of $12 billion. In the end, no one has a crystal ball, but sometimes there's enough clues to say, yeah, this may be a good deal under $13 a share if the company remains focused, but I've got to be okay with sitting on that money for a while and for a possible $9 downside in the near future, and pray the market doesn't turn upside down in the next 3 years. This is either going to be a fairly big company someday with an incredible software platform, or it will just be a billionaire's boys club. We'll have to see if the co-founders can keep egos in check. Leaders' actions sometimes speak so loudly I can't hear what they're actually saying. So just because Cathie Wood swallowed the red pill doesn't mean you have to. Assess your level of risk. Make sure your portfolio is not so overweighted with unicorns, and make a decision that you can live with in your portfolio that allows you to live another day. Remember, there are no cold strikes in the market. Imagine if you've only been investing in the market for 2 years or less. You decide to build a stock portfolio. You pick 2 or 3 stocks you think are going, well, to the moon because somehow you misinterpreted Warren Buffett's statement about diversification. And like so many people do, you think you're going to hit the jackpot on less than a handful of stocks that you selected with 2 years less trading experience. That's after realizing that you're going up against investment firms with years more experience, tons more information, and access at their disposal, and they can't consistently beat the market mid to long term, but you, the fairly new retail investor, you're going to, right? Here's a reality check. Buffett plays a different game than the retail investor. Berkshire Hathaway makes most of their money from mergers and acquisitions, not a game. If you made it this far in the video, I've got a little surprise for you. You'll see it somewhere in the video. The vast majority of retail investors can play. Mergers and acquisitions, M&A, is Buffett's real superpower. Stock investments is how he and Munger preserve and grow the money they earn from all those great companies that they own. The dividends on those few stocks they own makes them hundreds of millions, if not billions of dollars annually, which they use to stockpile more money to buy more, well, great companies. Not to mention, they've been able to beat the market more consistently on the stocks that they've owned than most investment firms. And that was without holding a portfolio full of unicorns. So if you're planning to bet your financial future into buying deep into a handful of unicorns, you'll have to be extremely lucky. And yes, some of you just might be, and if so, make sure to send me a link to your video. But for most, not so much. Many inexperienced retail investors, well, they bet the house on 1 or 2 companies. Their whole entire financial future is dependent on a few hopeful growth companies they're convinced is the future. And you know what? Sometimes it works out and you get lucky and you win. But most of the time, the market collects your chips and clears the table. What I love best about the stock market can be wrapped up in this quote from Mark Twain's book, Pudd'nhead Wilson. October. This is one of those peculiarly dangerous months to speculate in stocks. The others are July, January, September, April, November, May, March, June, December, August, and February. This speaks to why it's so important to use a reliable and replicatable process to analyze any company you buy or sell. Using the 4 scoring elements within the dumb method allow me to get a more complete view of the company and detach from the emotion of the lure of easy money and prevent me from becoming a bag holder. Based on everything that I've uncovered in this video, I've given Palantir a margin of safety score of 8. You have to make your own decision. My objective is to give you more weapons to think before buying. I'm not saying the dumb method's the only way. There are hundreds of systems out there. This is one that I've used successfully that is simple and straightforward and allows me to ask a few consistent questions across multiple industries to determine if a company is good or bad, or at least has the potential to be good. A good carpenter uses a consistent unit of measure as he or she builds something because it's efficient and effective and allows for consistency in work. So before you buy or sell your next stock, make sure you have a consistent method for analyzing a business to better secure the long-term successful performance of your portfolio. Now about that surprise, this right here. I have an extra copy of the hardback of The Snowball, Warren Buffett and the Business of Life. If you haven't read it, it's an excellent read to get a sense of the person Warren Buffett is and what made him who he is today. It is used, but it's in great shape. And to win a copy, let me tell you what you need to do. And I need to let you know, I'll pay for shipping. Type the word snowball just as you see it here, and anywhere in your comment, just type that, and I will randomly select out of the first 20 commenters, one person, and I'll notify you in the comments if you've won, and I'll also announce that winner in my next video. If you found this video helpful, please leave a comment below. Click the thumbs up icon and subscribe so you can be the first to get access to real investing information for real investors. Thanks for watching, and I'll catch you in the next video.